Hello, everybody. This is Henry Becker, Director of Research with Lighthouse Wealth Management. Happy Valentine's Day, by the way. You can see right here above or next to my head. Today is Valentine's Day. In this quick video, I'm going to talk about some of the changes we've seen in the market over the last 20 years or so. And I'm going to start with the fable of the boiling frog. You might have heard this before, where if you take a frog and drop him into boiling water, he just jumps right out. But if you put the frog into tepid water and turn up the heat slowly, he'll cook. So, and it's more or less, the whole adage is change happens so slowly you don't notice it. And that's more or less the case with the market. So I don't know that people haven't noticed it, but this might, after you watch or go through this video, you might say, I knew there was something in this, but I hadn't really been able to put my finger on it. And I think when we go through this, you might come to that conclusion if you haven't gotten there already. So let's flip over to my desktop and we'll take a look at a few things.
So welcome to my desktop, and what we see here right off the top, here's the number of publicly traded stocks in the United States in 1996, 7,322. If we fast forward to today, number of publicly traded stocks sits about roughly 3,500. We'll just call that cut in half. And a lot of that cut comes at the bottom. So if we look at IPOs in 1996, IPOs or initial public offerings, right? There were 845. IPOs in 2019, 159, okay? So a lot of IPOs back in 1996 were smaller companies. These would have been small, maybe mid-caps. IPOs in 2019, 159. I didn't look at the actual details, but I would hazard a guess that a fair amount of those were larger companies. So what happened? So along the way, there's been easier access to venture and private capital, okay? And then we also have increased corporate regulations, shareholder lawsuits, or the fear of shareholder lawsuits, and activist investor demands. So basically, if you're a smaller company and you're contemplating going public, you have to realize that you open yourself to lawsuits and investor demands, activist investors. Basically, an activist investor are people that, larger investors, hedge funds that think that, they can make better decisions than the board of the companies and so forth, and therefore try to use their influence to change corporate policy. So let's look at an example of Amazon. Amazon was founded in 1994, went public in 1997. Its opening market cap was $600 million. They were a small cap company when they came out. Facebook, on the other hand, founded in 2004, 8 years later, versus Amazon, which was only 3 years between founding and going public. 8 years for Facebook, went public in 2012 with an opening market cap over $100 billion. So it wasn't just large cap, it was mega cap when it came out. So the next thing I want to look at is, the complexion of the market right now, again, is heavily skewed to large cap. A lot of people are putting, not just individual investors, institutional money is going into large company stocks. And why is that? The first thing we can look at is, look at the biggest piece, tech. That's where everybody wants to be. That's where the growth, that's where the stories are. Second biggest piece, healthcare, but within healthcare you have things like biotech, which is, again, something that a lot of people are looking to add money to. And we have finance, communications, consumer discretionary. So now let's look comparatively at mid-cap, the S&P mid-cap index, which is the S&P 400. Well, the biggest constituent pieces are industrials and finance. Again, not the sexiest names in terms of investing, but not only that, but these have been somewhat laggards in the last few years. So dragging down the potential returns. And then if we look at small cap, S&P 600, we have very similar. It almost looks identical to mid cap. So what it's showing you is the complexion of the market is very different on the large company side versus the small company side. And I'll give you an example. If we look back at companies like Amazon, who they acquire a lot of other businesses when they're still really small, before they even come public. And a good example is one day, it was probably like 2 years ago, I was watching a video on CNBC, and it was showing the warehouse for Amazon. It showed the little robots that move things around. I thought, well, that'd be worth. I wonder who makes those robots. That might be worth investing in. So I did a little bit of research to find out that the company that makes the robots is owned by Amazon. Amazon acquired them as soon as they realized that the technology was useful to them, so they just acquired them. So they never even came public, ever.
So what does all this mean? What it means is we can't use the saying, this isn't your father's investing market. And the reason for that is, and you see those headlines every once in a while, or you'll hear people say, in relation to things that are, today's different than back then. This is something that's happened in most people that's been investing money for the last 10 to 20 years. This change has happened in their lifetime. It's just been so slow, it's been hard to recognize. So for us, what it means is small and mid-cap stocks are likely to struggle to provide the relative returns that they once did, meaning small and mid-cap stocks invested back, portfolios of small and mid-cap stocks. Surely there's small and mid-cap stocks out there that are going to do fantastic, over time. But portfolios of small and mid-sized stocks are going to struggle because there's less of those companies to choose from, and the really strong ones seem to stay private longer or get gobbled up before they ever come public anyway. So the struggles with small and mid-cap portfolios will likely happen because of how the market is structured today. So what it means to us as investors is changing how we go about building portfolios, because diversification in the old ways of having large cap, mid cap, small cap, that provided some level of diversification. Not so much anymore because there's so many large and mid-sized stocks. So the idea of diversification has to come from not just the asset classes you invest in, but also the different types of strategies that you invest along with as well. So my hope is that you've learned a little bit from this video, but also that you understand that we recognize these changes have happened in the marketplace, and that we consciously look at these things when we're building out portfolios or investment models or making changes and those types of things. So again, happy Valentine's Day. We hope you've got some value out of the video, and I thank you for your time.